I think today, the dovishness, I think the Fed have to be very dovish, given the recent volatility we've seen, and we've seen in the second half of last year that they are responsive to market volatility. So I think the Fed has to be very cautious in what they say and overly dovish. What that means is that the Fed rate hike is still in play, but I think the probability of that rate hike goes down quite substantially, particularly if we see this volatility continue over the next 4 to 6 weeks. If you have a look at two things which I think are very important, one, we've got the market, the US futures market being down at the moment, which means that they're probably a little bit sort of less inclined to believe the dovishness. And also, if you have a look at last Friday when the ECB announced effectively that they'll do more quantitative easing, you didn't see the US dollar rally too much versus the euro. And that tells me that the currency markets doesn't believe that a hike's in place.
But the Fed keeps telling us that they are data dependent. Shouldn't the Fed, shouldn't the ECB and all central banks be agnostic about these market gyrations that we are seeing and keep their eye on economic activity? They're not market strategists, they're central bankers.
Yeah, no, exactly. And I think the Fed's been very clear that they're data dependent. The big question is what data are they looking at and what do they find important? Because let's face it, there was no difference in the data really from, say, June last year to December last year. So what made them hike in December versus June? And the same argument can be made right now. There'll be no difference between, say, March and June this year. So it really comes down to, I think, one, you've got to be data dependent, but the Fed, in their responsibility, have to be cognizant of the broader markets. And if the world markets are very volatile and they start hiking rates and the US dollar appreciates quite considerably, they've got to be conscious of what that does to emerging markets as well.
All right, let's talk strategy, David. Is it all about capital preservation right now?
Look, I think that's got to be foremost in investors' minds. At the moment, you don't want to lose too much capital, and last year was fairly lean for most investors, so no one's making a great amount of money around the world. But I think you have to balance that up with the fact that there are some wonderful opportunities at the moment. So for Australian investors, where we do see the Australian dollar coming down further, you've got to have a look at offshore investments as very attractive, and you've got to have a look at those Australian companies which are earning revenue offshore and can benefit from the weaker dollar, also attractive. So, what I'd say is you have to be extremely selective at the moment, and you have to look at companies which are fundamentally very strong and their earnings are solid, which have been sold down with the broader markets. And then you can see some great opportunities around the world.
And energy and commodities, just one space that has been badly beaten up. But David, are we close to a bottom on that sector? And if so, would you advise clients to start rotating very selectively back into the companies with the cleaner balance sheets, the lower cost producers, for example?
Yeah, look, I think with oil, particularly when you have a look at the recent rally, we've got to be cognizant of the fact that it's rallied on short covering and rumours about an OPEC/Russia kind of deal to limit supply. So the fundamentals for the oil market haven't changed yet, and we've got to be very wary of that. So I wouldn't say we're at a bottom. We still can have more downside to come. But what I'd say from an investment perspective is that investors need to say, look, the market could go down to $25 a barrel. But are we confident over the next 6 to 12 months that it'll come up to $40 to $60 a barrel? And that's certainly where we're at. So there are bargains in the energy sector at the moment, but investors have to be very aware of the short-term risk if we start to see the oil price come back down.